And welcome back to Academic Market Insights. We're back very quickly. We of course, these are around for a bit of time, but we're Wednesday of the week that we're sitting here. We did a video on what is Delta. It's not anything that has to do with a river or anything like that. It's an option pricing factor. And part of how we like to do these videos is a little bit unscripted, where we will start asking each other questions like we're the student. And we ended up in a little bit of a spirited debate around what's the best first option trade. This was almost exactly 48 hours ago. And in the video, it said, well, maybe we should do a video about your first option trade. And 47 minutes after we said that and published the video, we got an email saying, you guys should do that. So here we are. Your first option trade. We have different opinions on it. Usually one of us is kind of lecturing and the other one is asking questions. Today we're going to swap back and forth a little bit because Dr. Ademiak, Dr. Alpha, has her opinion on the first option trade, and I have my first opinion on the first option trade. And they differ, and we agree to disagree. So with that, I haven't let you say anything whatsoever. Dr. A, do you have
I do. I want to jump in and say something. I
Yeah.
also want to point out your first option trade, both of our opinions are correct. So
Yes.
you
Yeah.
could, and that's, I think that we should be very clear about, we have a very, just because we differ in opinion, neither of us think that the other one is wrong. We have a
No.
preference.
No.
Both of these trades are good first trades. And if you're just beginning to start trading options, either one is good. You need to understand your risk levels. You need to understand your financial position, because some of the trades cost a little bit more money. Some of them cost a little bit less. Some of them have a different risk profile. So all of those things are important for you to understand you yourself as a trader. And again, all of what we're going to present to you today, these are all good, solid first options trades. So if you're getting into it and you're thinking about how to approach this, any of these would be a sufficient place to start. And I'd also like to say, if you like this video, please hit like. And if you want to subscribe, please subscribe. We're thrilled to be a part of this community. We love getting feedback. So thank you so much for the person who jumped in and said, yes, please talk about your first trade. This is something of interest. They're getting into trading. I know our favorite #1 fan is also very curious about the different opinions, particularly surrounding the first trade. So I'm excited for this video, and I hope everybody here also enjoys it. And if anybody wants to go deeper on any of these trades, so each one of these trades is unique in itself, and we could spend easily an hour talking about any one particular trade. So if somebody's more curious about, I don't want to spoil the trade strategies, but if anybody's curious about a specific trade, please let us know, and we'd be happy to dive deeper.
So, all right. With that, we're going to talk about your first option trade, but I'm gonna get all fired up about um, what I think is prohibitive for a lot of people with respect to options. They're intimidated, and I'm going to explain why you should not be intimidated by options. And the way that I'm going to explain that is I'm going to go through planning the trade and the basics behind planning the trade. There's not any math in there. It's more of just a little bit of math, but it's grade school math. And then we'll run through the best first strategies. I've got a couple of them, and Dr. A has one as well. As she said, we don't, just because we have different opinions, part of it has to do with the organizations that we worked for back in the day, which there's absolutely nothing wrong with that. That her trade's a little different than mine. We're just overselling that one, aren't we?
Yes. Well,
But just because we disagree, we don't want everybody to think that you've got to vote Team Dr. A or Team Dr. Rhodes. It's
yeah.
we're all on the same team here.
And
So
it
then we'll
really,
go.
I was just, and it's, sorry to interject. And it also really, it's an individual personal choice.
Yeah, yeah, yeah. So, all right, planning the trade. And this is where I get all fired up. Every option trade, I like to tell a story when I'm teaching this in the classroom, and I'll give an abbreviated version. But I was on a board, and a new board member knew that I was running education at SIBO, and was interested in options, and ended up sitting next to me. And they asked me what I thought, just like right in the middle of a meeting once. They said, "What do you think about buying the 160 calls on IBM right now?" This is about a decade ago when Buffett was buying IBM, so it was in the news and traders were thinking about it. And my response was what you guys are looking at right now. What's your price target and where do you think the stock's going? The correct question is not what do you think about buying the 160 call? It's what does the other person think about buying the 160 call based on an outlook and the pricing of that 160 call. Um, so you come up with some sort of price target and what's the time frame behind reaching that target. And it could be a trend. If a stock's in an uptrend and you draw a trend line out 30 days and the stock's, 10, 15 points higher and you think it's going to maintain that trend, that could be your target price. It could be based on fundamentals. A lot of professionals use options, use target prices, and will use options to exit stocks using a covered call, which is one of the trades I'm going to talk about. So this is all you need to do. And then you need to go look at option pricing. So there's no using a Black-Scholes calculator. There's nothing else into account here. Just determine a price target, determine the time frame behind reaching that target, and then take a look at option pricing. So
I'm
my
so glad.
yep.
Wait, I want to interject. Sorry, I'll raise my hand.
Yep.
I'm so glad you also talked about the time frame. So
Mhm.
that is something that's unique compared to the equity itself. Is when you're thinking about an equity, you're thinking about directionally, is it going to go up? Is it going to go down? You come up with a price target. With options, you also have to think about when is all of this going to happen. So you can be right, but with an option, it might not be the right time. So you don't necessarily reap those benefits from it. So I'm glad you brought up it's coming up with that price
There,
target.
there, there's nothing worse than owning a call option that expires on a Friday and you come in Monday morning and the stock's up 10%.
Yeah.
But that is part of that's where the time frame comes from, right there.
Mhm.
So my first trade here is and this was when I worked for the Options Institute at the Chicago Board Options Exchange. This is what we would say should be your first option trade. And the idea here, and I'm going to add to that. I'm going to say this should be the first option trade for somebody that is familiar with trading stocks and thinking about moving into trading options. My other trade, and I think Dr. A's trade, is going to be more geared towards somebody that's not really involved in trading stocks, but wants to start doing option trades.
Yep.
Now, the covered call is a really good first option trade because you're doing something that you would intend on doing. And that would be if you've got a target price for a stock, you can sell a call option and take on the obligation to sell that stock at that price. We always like to say that you're a happy seller of that stock at that price. And then you take a look at what are you going to get paid for selling that option, and is it enough of a premium for you to take on that obligation? And my example, we're going to use a very familiar stock, JP Morgan. I think everybody knows JPM is JP Morgan. I took pricing for about a month ago or so. And when JP Morgan was trading right at 239, uh, if I thought the stock was going to trade, if I owned 100 shares of JP Morgan and I had a target price of $250, I could sell a 1 month 250 call for $3. And what I'm doing is I am taking on the obligation to sell my shares at 250 if the stock is equal to or above 250 at expiration. It could also be called away from me early, but if I'm a willing seller of the stock, that basically I'm taking on the obligation to do something that I would be willing to do. If the stock is not over 250 at expiration, or and I still own the stock, the option might expire with no value. I might actually think about selling another call and taking in more premium. Um, the payoff for this trade looks like this. In my example, we're selling the option for $3, and the maximum profit that we can make off of this trade is $14. We're giving up some of the upside on JP Morgan, but again, when we considered selling this call, we were a happy seller of the stock at 250. I do like to, I've included a gray line, which just shows the Delta One or the stock performance going up and down. And back when I was in a position where I could try to influence terminology and stuff, I always wanted to refer to this point where where you would have regretted selling the option, where the stock P&L is higher than the covered call P&L. I always wanted to refer to that as the point of indifference, where at that very point you're indifferent as to whether you had sold the call or not. Below there, you're pretty happy that you did. You've
Mhm.
outperformed the stock. Even if the stock goes to the downside, you're pretty happy that you did. Above there, where the gray line is now above the payoff, you may be regretting, but again, you were supposedly a happy seller of the stock at 250. You don't have to be thrilled if the stock's way up at 270.
No.
Yeah.
So I love this trade as a first trade if, and this is a big if, you already own the shares.
Mm.
So the reason why I don't like it if you don't own the shares is it's very costly because one option contract represents 100 shares, right? And if
Mhm.
we're looking at a $239 stock, that's going to be for 100 shares, $2,390. Well, that's an expensive initial first. Am I saying that correct, Dr. Rowe?
It's 23,900.
23. Thank you. So it's
Yeah.
even more, right?
Sorry.
And yeah, I
23,900.
apologize. Yep.
Okay.
Good. I didn't think that was okay, good. And I remember, and the reason why this came up, or yeah, because it's 1,000 shares, right? Yep. Um, I'll never forget my dissertation advisor wanted to do a covered call on Apple, and this was when Apple's trading several hundreds of dollars. I looked it up. It's 193.37 right now, but I believe Apple got up to, I want to say like $600 at one point, if
Yeah,
my
before they
memory.
split it. Yeah.
Yeah. And he wanted to do covered calls, and he's like, I need 100 shares of Apple to do this trade, um, which is a staggering amount of
Yeah.
money then.
Yeah.
So, again, if you own the underlying stock, I think this is an amazing first trade. But if you don't, I think it's cost prohibitive because of just that control of 1,000 shares.
Yeah, no, it's 23,009 to buy the stock. You do get to offset it by with $300 of selling the call, but that ain't
Right.
much at
No,
all.
it's not.
Not at all. So
And the other thing is the covered call, and this is something that, at least at the firm that I was with, we would discuss from time to time, the risk of this. And that's not something we necessarily think about, but if the JP Morgan goes to zero,
yeah, that line
then
keeps
you
going
have
going
lost the
down.
23.9. And I mean, you're collecting the 300, but it's not something we necessarily think about, right?
Not at all.
We've got that unlimited downside for the short call, and then we also have that, or not unlimited, but limited towards if the stock goes to zero. So we've got that loss, and then we've got the potential loss of the underlying stock itself. Now, realistically, is that going to happen? Probably not.
Hopefully not.
But again, and this is another reason why I'm cautious about this particular trade for your first, if you don't already own the underlying, because if you own the underlying, you already have that downside risk.
Yeah. Yeah.
So if you don't own the underlying, then you've created that downside risk, and can be cost prohibitive to get into it.
So let's do a cheap trade.
So the trade that I really like is a cheaper version of kind of Dr. Rowe's philosophy on this idea of capturing some of that upside. So in the covered call, you have that price target, and you're just assuming that the stock's not going to go through that price target. And if it does, you're still okay with the sale of it, because you have decided that that's an okay price to sell at. So another way to kind of capture some of that upside movement, and I like this trade particularly if you've been already trading equities, so you have in your mind equities that you like, equities that you think is going to go up, and you might even have some specific price targets for some of these things, right? So if you have a price target and you have kind of an idea of when it's going to happen, going with a deep in the money call is a great way to essentially have all of the action of a stock. You get that leverage that we talked about last week, and you now have protected downside risk. It's pretty amazing. So let's go take a look at our example. So in this example, we're still picking on that same time period where JP Morgan was trading at 239, and we still have the same philosophy. Again, nothing's changed. It's just a different way to execute your beliefs. So we're not changing any of our beliefs, but our target price of 250, which again was the same what we had in our covered call. And what we're going to do is buy what's considered a deep in the money call. So it's a strike of 200, right? And it's trading at 239. So we already know that we have that $39 built in of intrinsic value. It's going to cost us $40.25. So we're paying for a little bit of the extrinsic or time value. So you are paying for that, but you believe that the stock is going to go up still by another $11. So you might as well figure out a way to capture this. And so we're hopefully not only going to get that intrinsic value of that $39. So this is going to be a very, very deep in the money option. You're also going to hopefully capture a little bit more. So let's take a look at our P&L graph. P&L. Woo!
Yeah.
You can see they are right on top of each other. And I believe we had discussed this off screen. Dr. Rowe was telling me that the option actually had a delta of 0.95 or 95. So this is going to be a way to really have something that's behaving like the stock. So you get all that wonderful upside of the stock, and you now have limited the amount of money that you could lose. So JP Morgan could go all the way down to zero. And if you had bought it at $239, you would lose that full value of $239 versus this deep in the money call. The most you can lose is $40. Now, we don't think that that's going to happen because our target price is 50. So we think we're going to get that $39 plus the extra 11, so our $50. And it cost us $40 to get into it. So we're hopefully going to be, or $40.25. Hopefully then we're going to be able to reap some of this reward. Again, this isn't the cheapest of all trades, because when we think about this contract, we're essentially controlling 1,000 shares. And if we want to help reduce some of these costs, because again, it's not that cheap. You got to love the downside risk
Hey,
protection.
Larissa, it's 100 shares.
100 shares. Thank you. I know it's been a tough morning this morning.
Do you want to back up a little bit?
No, that's okay.
Okay, all right, but yeah, it's
Yeah,
100 shares. And I know,
100 shares.
and I know why you're saying 1,000 shares. It's because we were doing 10 option examples before
Ah,
in a
okay.
different presentation, and I think you've still got that in your mind. But it's and typically we do 10 option trades when we start doing delta things because we need to have partials on the shares. But I know where the thousand's coming from, and it's one of those things that I know you've had stuck in your brain off and on just professionally. It's 100. Sorry.
Thank you. Thank
I
you.
just
No,
gotta.
thank you. I don't,
I'm saving us from all those comments.
like, what the heck?
Yeah. So
Or
it's
as
it's 100 shares. Yeah.
my kid would say, what the shrimp? So, but if you're looking to reduce some of this cost of the 100 shares,
Yeah.
what you would do is then possibly sell an out in the money call, which is what Dr. Rowe did in the covered call. So that would help offset some of that cost.
Okay. So finally, a third strategy and kind of building on the trade that Dr. A came up with. I'm actually stealing half of this trade from her. But starting out, a vertical spread, it's a really good first option trade because you have defined risk and defined reward.
Yep.
And this is not an issue with the call option that we took a look at buying in the previous example, because there wasn't a lot of time value.
No.
But often people will be looking to um, buy a call option because they've got an outlook for a stock and they only have a few $100s to spend as opposed to a few $1,000s. And if the stock reaches their target price, the call option maybe doesn't offer that much of a profit. So you could look at, and we would refer to that as the call option being expensive relative to our outlook. My favorite mentor, one of my favorite people in the world, Marty Kearney. Every time I talk about vertical spreads, I tell this story to the point where there are people in the room will go, "Oh my gosh, again!" But yes, not everybody's heard this. He would always like to say, if you've got to buy an expensive option, and if the option that you're looking at buying doesn't really give you the kind of profit and make it worth the risk, sell an expensive option. Now, that's not exactly the motivation on this one, but if we were to buy if you were about to buy a 230 or 240 strike call option, there would have been a lot of time value in it. The long call that we used for the deep in the money call was the 200 strike that didn't have a lot of time value. And we're sticking with that one for our vertical spread. We don't own the stock. And and this is where Dr. A and I differ just a little bit, but we do like each other's trades. That where if you don't own the stock, I think a vertical spread's a pretty good first option trade because generally it can be very inexpensive.
Yep.
And you can define risk and reward with it, and sometimes even do one for one with an individual stock. What we're doing here is we're taking that long exposure from buying the 1 month 200 call. And again, we've got that $250 strike price or target price. And to offset some of that time, in fact, to offset all of that time value. In fact, in a second, you're going to see that below 250, the vertical spread actually outperforms owning the stock. But in this case, we can offset that 40.25 with $3 of income from selling the 250 call, and we end up spending 37.25 on the trade. And that is our maximum potential loss. Here's our payoff for the bull call spread, buying the 200 call, selling the 250 call. You can see up there at 250. I always like to say that the payoff takes a right and kind of veers to the right a bit, but our profits would actually be capped there at $12.75. Do remember, if you bought the stock there, if you bought the stock and you sold it at 250, your profit would be 11. If you had used Dr. A's long call and you'd sold the call option and just assumed there was no time value in there at 250, you'd have made what? $9.75. So on a dollar basis, this actually gives you the best profit at 250 or above relative to the three trades. And again, I'm not trying to say mine's better than yours.
Oh,
Your
no.
trade, if we woke up, if we put your trade on and JP Morgan's getting bought out by Bank of America the next day at 270, we're going to be loving your trade and hating my trade. You know, I mean, we were happy with the 250 target
Yeah.
price, but one of the things with my covered call trade and my bull call spread trade is we do limit the upside. And I authored some of the option material for the CFA program, and my co-author liked to refer to this area to the right where the stock continues to go up, but we've limited our upside. He liked to refer to that as giving up the sweet spot.
Yep.
Um, we're
So
giving
I
up the sweet
actually
spot.
really like the vertical spread. My mentor, where I used to work, Joe Taraclo, also a huge fan of the verticals. So, from my perspective, what I don't like about this trade, and it's the only thing I don't like about this trade, because otherwise I'm a huge fan of really managing that risk. And you're managing it on the upside, you're managing on the downside, and you're reducing cost. Big fan of reducing cost. My concern is for a first trade is that it's a two-legged trade. So we're looking at
Uh,
two, and again, for a very first trade, I think it's a little more comfortable with the long call because you're only buying one. And again, it's very similar to just buying the underlying anyway. But I do love vertical spreads. It's one of those trades that I think aren't exploited as much, and they really should be. And it's particularly for new traders, and for old traders. It's just a good trade all around.
Yep. The issue with the vertical spread, if you do it at the market, is you are dealing with two bid asks.
Mhm.
And if you saw the light bulb go off above my head, that's because we're going to do an episode on trade execution.
Okay, good.
Because in the option market, outside of maybe a dozen really liquid markets that are a penny or two, you know, that have a bid ask spread of a penny or two, it really does make sense to use limit orders on option trades. And there's a methodology that I use that I rarely miss a trade. I say that I missed a trade this week using it. There's a methodology that the week we're talking is the first full week after the tariffs were announced. So
Mhm.
there's a lot of missing trades this week. So it's not just me. Don't ruin my credibility on that one.
No.
But that the one of the issues with the vertical spread is there's a little bit more execution risk, and there's in if you're brand new to options, you're going to want somebody to hold your hand as you do your first trade. And when I say that, most of the good discount brokerage firms will have a trading desk that you can call and say, I'm getting ready to input my first vertical spread ever. Am I doing this correct? And they will, you know, they'll give you a little assurance. And I know from dealing with option traders for almost 20 years now, and of all levels, everybody wants a little bit of assurance before they put that trade on.
And the brokerage firm wants to help you. They
Oh yeah.
want you to be successful so that you continue to trade with them. That is their goal. So if you think, oh, I don't want to bother them, they want to help you.
Oh,
Take
absolutely. In
advantage of the resources.
In fact, there's one of them, and I'm very neutral, but there's one of them that has a whole division of help folks that if you move your account from ABC to XYZ, they're very familiar with your previous platform, and they help get you up to speed on your new platform,
Yeah.
which I just think is an absolute stroke of genius. You know, because I think that's one of the prohibitive things for a lot of people. I don't want to trade. I don't want to change. I've had the same broker from 1999, and I know how their platform works. I'm too old to learn new stuff. I'm not
Well,
going.
having said that, we appreciate everybody who's joined us. We hope that your first option trade is successful. We would love to hear about it, and your broker would love to hear about it. They also love the success stories. Again, that is why they're in business. If you like this video, please hit like. And if you are not a subscriber, please subscribe. And if you have constructive feedback, we are open to it. And any topic that within the realm of the financial markets, we are happy to address. With that, thank you so much.